Good evening from New York. It's 5:56 p.m. on Tuesday, March 24th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are now closed for the day, and what a day it was. Let's get right into it.
So here's where we closed. The S&P 500 finished at 6,557, down about 1/3%. The Nasdaq took a harder hit, down 82 basis points to 21,767. The Dow held up best, off just 17 basis points at 46,131. But the standout number is the Russell 2000, which actually gained 46 basis points to 2506. The VIX, sitting at 26.87, tells you fear is elevated, but not panicked. The 10-year Treasury yield at 4.39%, the 2-year at 3.62, giving us a positive 77 basis point curve spread. The regime right now is a war-driven supply shock with a thin layer of diplomatic hope sitting on top. Markets gave back most of yesterday's ceasefire rally because the credibility of those Iran negotiations deteriorated throughout the session. Three drivers today: the collapse of the Hormuz reopening narrative, record refining margins signaling deeper commodity stress than headline oil prices suggest, and a sharp divergence between small-cap cyclicals and mega-cap tech that's telling us something important about how the market is pricing risk.
Let's start with the big story. Yesterday, markets surged on Trump saying the U.S. and Iran were in productive talks. Today, that narrative fell apart. What happened?
The credibility gap widened considerably. Trump said from the Oval Office today that the U.S. and Iran are in negotiations right now, and that Tehran is talking sense. But Iran continues to flatly deny direct talks. CNN reported that an Iranian source described U.S. outreach, but explicitly said full negotiations have not begun. Meanwhile, the Wall Street Journal reported that the Pentagon is readying 3,000 soldiers from the 82nd Airborne for deployment to the Middle East, and the administration is still pursuing a $200 billion war supplemental from Congress. So you have diplomatic rhetoric going one direction and military posture going the other. Markets priced that contradiction accurately today. They faded the rally.
And the situation on the ground in the Gulf sounds genuinely dire.
It is. Kuwait Petroleum CEO spoke at CERAWeek today and called the Strait of Hormuz closure beyond catastrophic. Kuwait has declared force majeure on all delivery contracts and shut down oil wells. They're only producing for domestic consumption. He said it will take 3 to 4 months to restore full production even after the strait reopens because wells have been shut in. The IEA emergency release of 3 million barrels per day, he said explicitly, does not compensate even for Iraq's curtailments alone, let alone Saudi Arabia and the UAE. And here's the number that really matters. Kalshi prediction markets are pricing less than 25% odds that tanker traffic normalizes before April 15th. Even by June 1st, it's only 67%. This is not a 2-week disruption. This is a multi-month supply-constrained environment.
And Total Energy's CEO had a striking comment about refining margins.
Patrick Pouyanné told CNBC at CERAWeek that the world has never experienced refining margins at these levels, specifically citing Asian jet fuel. Brent is around $103, down from $111 on Friday, but the product market, gasoline, diesel, jet fuel, is running far hotter than crude. Gasoline is $3.98 a gallon nationally, up 35% in a month, according to AAPL. Jet fuel is up 106% in the same period, according to the International Air Transport Association. And this is the part markets are underpricing. About 30% of global fertilizer moves through Hormuz. That supply is cut off just as the Northern Hemisphere spring planting season begins. Pouyanné also warned European natural gas, currently around $18 per million BTU, could hit $40 over the summer if the war drags on, because Asian demand rises just as Europe needs to refill storage.
That fertilizer angle is a second-order effect I don't think enough people are tracking.
It's the sleeper risk. Here's the causal chain. Iran closes Hormuz, which cuts Gulf fertilizer exports, which jeopardizes spring planting globally. Kuwait's CEO said some developing nations could see a 50% harvest reduction, which tightens food supply by late summer, which feeds directly into food price inflation, which then shows up in CPI with a 3 to 6 month lag, just as the Fed is trying to manage an energy-driven inflation spike. That's the kind of second-order pressure that transforms a geopolitical event into a structural inflation problem.
And that yield move is exactly why we need to talk about the Fed. What does all of this mean for the rate path?
This is the most important shift of the past month. 2 months ago, markets were pricing 2 to 3 rate cuts in 2026 based on a soft landing narrative. That narrative is effectively dead. The 10-year at 4.39% is telling you the bond market sees persistent inflation risk. What was a rate cut story is now shifting toward a prolonged hold, with the risk tilted toward tightening if energy-driven inflation proves sticky. The Fed is trapped. They can't cut into a supply shock inflation with oil above $100 and food prices accelerating. But they also can't hike aggressively without crushing an economy already absorbing a massive energy tax on consumers and businesses. The most likely path is an extended hold through at least the third quarter of 2026, with the Fed using language to signal they're watching inflation expectations very carefully. If Brent stays above 100 for another 2 months and fertilizer shortages push food CPI higher, the conversation shifts to whether the Fed has to hike in the fourth quarter. That's not the base case yet, but it's no longer a tail risk.
So, who are the clear winners and losers from today?
Let me break this down by time horizon because the cyclical and structural pictures look very different. Cyclical winners, upstream energy producers, are the obvious beneficiaries. Oil above $100 with refining margins at record levels means cash flow is extraordinary, even for companies with some production offline, like Total Energies. U.S. shale producers benefit from being outside the war zone entirely. Defense contractors are cyclical winners as the administration pursues a $200 billion supplemental and deploys more troops. And domestic fertilizer and agricultural chemical companies benefit from the Gulf fertilizer cutoff because it redirects demand to non-Gulf sources. Structural winners, IA infrastructure hardware, specifically the companies building physical compute. ARM Holdings, ticker ARM, launched its first in-house CPU today with Meta, ticker META, as debut customer. Micron, ticker MU, reported $23.86 billion in quarterly revenue, nearly triple year-ago levels, with 80% gross margin guidance. The memory shortage is structural. Micron's CEO said customers are only getting 50 to 67% of their requirements. Dell, ticker DELL, was up over 8% today on the hardware build-out theme. This IA infrastructure cycle persists regardless of the geopolitical environment. Cyclical losers, airlines are getting crushed by jet fuel costs up 106%. United CEO said sustained prices at this level mean $11 billion in additional annual fuel expense. Low-cost carriers are particularly exposed because fuel is a higher share of their cost structure. Consumer discretionary broadly suffers as gasoline at nearly $4 a gallon acts as a tax on household spending. Structural losers, rate-sensitive sectors like real estate. Only 23% of REIT stocks are above their 50-day moving average, and 45% near 52-week lows. With the 10-year at 4.39 and trending higher, mortgage rates and cap rates keep squeezing valuations. Software names also face structural pressure. Salesforce, ticker CRM, down nearly 5%, Workday down 4.5%, as enterprise customers scrutinize discretionary IT spending in a higher cost environment. Microsoft, ticker MSFT, down 2.5% today and over 20% year to date, faces the added headwind of Copilot adoption problems flagged by Melius Research, who called the product reorganization a red flag.
That Russell outperformance caught my eye. Small caps up while large cap tech falls. What's that telling us?
It's a meaningful rotation signal. The Russell gaining 46 basis points while the Nasdaq dropped 82 basis points reflects capital moving toward domestically oriented cyclicals and away from mega-cap growth. Small caps tend to be more energy sensitive on the revenue side. Many are domestic industrials, materials companies, regional banks, and less exposed to the strong dollar headwind that's pressuring multinationals. The advanced decline ratio today was 356 advancing versus 158 declining, so breadth was actually healthy underneath the headline index weakness. The problem is concentrated in mega-cap tech. Among the Magnificent Seven, Microsoft dropped 2.5%, Alphabet down nearly 3%, Meta down 1%. The only sector with 100% of stocks above both their 50-day and 200-day moving averages is energy. That is a stark divergence.
What about that private credit story? Shadow banks blocking withdrawals sounds ominous.
The Telegraph reported that two of the world's largest shadow banks blocked cash withdrawals from flagship funds. This connects directly to the stress environment. When volatility spikes and correlations shift, leveraged credit vehicles face redemption pressure. This is a financial plumbing story. It doesn't mean systemic crisis, but it's a canary. Private credit has ballooned in size during the low-rate era, and these vehicles were never stress-tested against a genuine supply shock inflation combined with elevated geopolitical risk. If energy prices stay elevated and economic activity slows, the credit quality of leveraged borrowers deteriorates, and that's when withdrawal gates become a bigger problem. Worth monitoring closely.
What's the risk case investors should stress test against their current positioning?
Let me give you both sides with numbers. Base case. Diplomatic back channels produce a framework agreement within Trump's 5-day window. Brent pulls back to $85 to $90 by late April as Hormuz partially reopens. The 10-year yield drifts to 4.15 to 4.25%. The S&P recovers to 6,800 to 6,900 by end of second quarter, and the Fed holds rates through September, with dovish language returning by the June meeting. Probability, roughly 40% based on prediction market pricing and the diplomatic trajectory. Risk case, negotiations collapse, the U.S. strikes Iranian energy infrastructure as threatened, Brent spikes to $130 to $140, European natural gas hits $40 per million BTU as Puyane warned. The 10-year yield pushes through 4.75% on inflation expectations. That forces the S&P down to 5,800 to 6,000, an 8 to 12% correction from current levels, concentrated in consumer discretionary, technology, and financials. Airlines face a 15 to 20% drawdown from here. The Fed is forced into an emergency communication pivot, potentially signaling willingness to hike by the September meeting. Food inflation from the fertilizer shortage compounds the energy shock with a 3 to 6 month lag, making this a multi-quarter inflation problem rather than a transient spike.
Given those scenarios, how should investors be positioned?
Highest conviction, energy producers. Maintain and gradually increase over the next 4 to 6 weeks. The supply-constrained environment persists under both scenarios, and the sector has 100% of stocks above both moving averages. Specifically, diversified majors with non-Gulf production and U.S. shale operators. Secondary conviction, II infrastructure hardware, Micron, ARM, Dell, semiconductor equipment names like KLA Corporation, ticker KLALC, which was up nearly 5.5% today. The memory shortage and CPU build-out are supply-driven themes that are structurally insulated from the geopolitical cycle. Maintain exposure structurally. Tactical hedge, short-duration treasury bonds. With the 2-year at 3.62 and the curve positive at 77 basis points, you're getting paid to sit in the front end while avoiding the duration risk of a further 10-year sell-off. Core allocation should overweight energy and commodity-linked equities and II infrastructure hardware. Avoid rate-sensitive consumer discretionary, software names trading at elevated multiples with decelerating growth, and airlines. Immediately reduce exposure to any leveraged credit vehicles where liquidity terms are ambiguous. The shadow bank withdrawal story is a warning.
How does it all fit together?
When you step back, this is really about the global economy being held hostage by a single waterway, and every asset class is repricing around whether and when that choke point reopens. Oil above 100 drives inflation expectations higher, which pushes yields up, which pressures rate-sensitive equities and real estate, which forces the Fed into an extended hold that removes the monetary policy safety net markets had been counting on. The fertilizer disruption extends this from an energy shock into a food security crisis with a multi-month lag. Meanwhile, capital is rotating toward the two themes with genuine pricing power: energy producers who benefit directly from scarcity, and AI hardware companies operating in their own supply-constrained cycle where demand far exceeds capacity. Everything else is caught in the crossfire.
Give us the 3 takeaways to close.
1. The risk. The credibility gap between U.S. diplomatic rhetoric and military posture means markets should not trust ceasefire headlines until tanker traffic physically resumes through Hormuz. The prediction markets say that's months away, not weeks. 2. The insight. Refining margins and product prices are running far hotter than crude oil suggests. The headline Brent number is understating the actual inflationary impulse hitting consumers and businesses right now, and the fertilizer cutoff creates a second inflation wave that hasn't been priced in. 3. The positioning idea. The barbell of energy producers and II infrastructure hardware gives you exposure to the two supply-constrained supercycles simultaneously while avoiding the sectors most vulnerable to the rate and consumer spending squeeze. Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.